Hey traders, welcome to another lesson. So let's talk about a key question here, key discussion here, which is candlestick pattern actually useful or not? This has been one of the key questions that I believe if you are someone who's been staring in front of the chart, you should be questioning yourself why. So we have heard of a lot of really basic lessons, really basic discussion, which is, oh, if price comes here, my entry confirmation will be based on a pin bar or a doji. So common beginner knowledge is entry confirmation equals to candlestick pattern. So traders love to have basic things like, oh, if I see a pin bar, let's say price goes down, if I see a pin bar, I will go long. That means high chance price will reverse back up. If I see price goes up, if it hits some sort of resistance on the left, if it shows a doji candle, that means we are reversing lower. So is it actually correct or not? Because from a very surface kind of lesson, I will say yes. Okay, because technically speaking, when you see a pin bar like this, it tells you that within, so hear this carefully, within this specific candle, it also has to be based on what kind of time frame are you looking at. If you are looking at the lower the time frame, so remember this, the lower the time frame, less reliable. So if you are looking at a pin bar on the 5-minute, it'll be a lot less reliable. Why? Because it basically just tells you what's happening within the 5 minutes. Does that mean that 2-3 hours later we're expecting price to reverse? No. So I'll give you a quick example here. If let's say you look at the 5-minute chart on pound dollar, how many pin bars do we have? Lots and lots of them. So if you really were to rely solely on candlestick pattern itself, rely on doji, pin bar, engulfing pattern, you probably would have gotten stopped out tons of times. So now the key question here back on question, is candlestick pattern actually reliable? And the answer here is not really. So what kind of entry confirmation do I personally use when I'm looking to execute a setup? So I'll just give you all some quick lesson here. So I categorize my setup or my entry model, again inside our trade club. This is what I actually teach. I split them into two kinds of entry model. First one is conservative entry model, or entry technique is the same thing. Then we have the second one, which is aggressive entry model. So conservative entry model will be waiting for entry confirmation, or so-called waiting for entry trigger. So entry trigger basically means if I see price doing XYZ, for example, if I have a support level here, a horizontal support level, if I see price comes into the support level, reject multiple times, I wouldn't enter at the low. I would wait for price to break the following structure, come back and do a retest, and showing some sort of candlestick pattern or some form of confirmation based on your own model, based on your own approach, I'll then say yes, I'm looking to go long. So the whole thing here is we will wait for an actual response at this level, and then we observe what's actually happening here. Before we pull the trigger and say, okay, I am fine, I want to go long here. This is what we call a conservative entry model. An aggressive entry model has two different types. Okay. First one is aggressive reversal entry. Second one is what I refer to a limit order entry. Okay, so aggressive reversal entry means price goes up, for example, and out of nowhere you just say, I want to short it here, and I'm expecting the price to reverse. This is what we call shorting the high or low kind of entry model. Limit order entry, although is categorized under aggressive entry model, but it is considered a very safe one, because before we put on the buy limit or sell limit, we often have to wait for a price to tell us, to give us a lot of confirmation, a lot of evidence before we start placing a limit order. So limit order could be, let's say price is going lower, okay, it's breaking below the support, and you basically just say that, okay, I want to enter right here, and I don't care what's happening, I just wanna enter there. Okay, so limit order also has another name, which is what I refer to price-based entry. So this is something that you should be taking note of. Let's say we are putting a sell limit here. Price-based entry. Okay, price-based entry simply means you are being sensitive to your entry price. That's it. Because the only reason why you put on limit order is because you say that from a logical standpoint, I want to short it here, not any higher, not any lower, but at this specific level. Why? Because you have a very mechanical approach to trading the market. I personally, I will always suggest you all, if you are a new trader here, or if you are a struggling trader, always have issues dealing with overtrading, revenge trading, or FOMO, or any sort of emotional or impulsive behavior, I will always suggest you to go for a limit, to have all your entry system set with limit orders. Why? Because it takes off a lot of psychological pressure. The feeling of, I'm unsure whether should I go long, I'm unsure whether should I take it here or later, I'm unsure should I actually wait for confirmation. If you are someone who is struggling with hesitation, go for a limit order based entry model. Okay, so now talk about why do I always say candlestick pattern itself is useless. I wouldn't say it's useless, but you just don't have enough evidence. So let me ask all of you. So let's say today you want to short the double top. You want to short it here. Okay. Just because price forms a pin bar here, does it necessarily tell you that we are reversing? No. So here comes to an important thing, important lesson to you all, which is assessing price behavior is much more helpful. So what I personally like to do is to have a trading system combining both limit orders entry, which I'll talk about it later, and a price behavior based entry. So price behavior simply means I won't be entering just based on one candle. I would much prefer seeing multiple rejection candle or price slowing down. Assessing price slowing down, assessing the angle of the rejection, assessing the number of wicks and tails. These are what we call assessing price behavior. So by assessing the price behavior, it would then allow you to observe the market with a lot more patience and also at the same time gathering more evidence. By simply entering a setup just based on a candlestick pattern, to me, it's just way too surface. So what I like to do is, okay, when I'm looking to take a position, what I love to assess are a few key elements. First one, angle of the rejection, or speed of the rejection, or the next one is, do we have any follow through? I don't like to enter a reversal just simply based on the candlestick pattern. I'll only enter a reversal setup if I see price actually do first thing, having a shallow angle, we actually start reversing lower, and we actually breaking out of a structure. That's normally the time where I'll say, okay, I'll short it here because we have price slowing down, or maybe on the left we have price hitting a major resistance, and also at the same time we have price breaking below this structure. That will again give me a lot more evidence, as opposed to just say, okay, I want to short it there based on a candlestick pattern. Okay, then I'll go to the second thing. So under what circumstance will I wait for a limit order? So I used a limit order on really simple setup, such as a break and retest. So if let's say today price is overall pushing lower, is on a downtrend, I will always enter the setup based on a limit order, because when you have a clear, first thing, clear market structure, clear market direction. So remember, market structure and market direction are two complete different things. So market direction simply means, is it going up, down, or sideways? A market structure means, are we on a strong trend, weak trend, are we channeling, are we consolidating? These are market structure. And also, do we have a clear BOS? When you have a clear market structure, clear market direction, a clear BOS, use limit order. Why? Don't bother, wasting your time on assessing price behavior when the market is simply on a very clear trend. So let me show you all something here. So if I were to just show you all something here, within our trade club, we have plenty of lessons on this specific topic. One key one is simplifying your trading, rule-based, making things more mechanical. So you see this one, how to simplify your trading and gain clarity. So to me, simplifying your trading system is what you actually need. Even though one of the common struggle that most of us here have as a manual trader, having a manual trading system, that means we trade price action, is more of a discretionary based trading, is to make a discretionary approach to a mechanical as possible. So today, if let's say you're trading purely based on price action, to me, it is very difficult to gain consistency. Why? Because every single time you have a slight different approach. And that's exactly why, for me personally, I have different entry model, and I have rule-based entry or mechanical entry system that allows me to turn a price action trading approach into a mechanical rule-based approach. So if I see price doing XYZ, I will then wait for confirmation. If I see price doing XYZ, I will then use a limit order. So now go back to it. So under what circumstance should you use limit order? So like what I say, the best time to use a limit order is often when you see a clear market structure, clear market direction, and you have a clear BOS, a clear break of structure. When's the time where you actually need to wait for an entry confirmation or a candlestick pattern? Maybe it's something that you like. What's the exact time where you have to wait for it? Most of the time is when market is on a pro trend or on a parabolic trend where you just go up, or down, down. You just need to wait for something to shift. You can't just catch a falling knife. I'll give all of you a very good example. So if you want to capture this, you may capture. Okay, so I'll show all of you a very good example on gold. So if you look at gold right now, okay, especially for the past few months, we have been on a so-called pro trend. When price is on a pro trend, there is no reason why price goes up. It's simply because it's just too strong, lots of optimism in the market. That's it. Don't try to find reasoning when market is on a pro trend, because the pro trend, the parabolic trend, they can go a lot further than you thought. And that's also why I always tell traders, don't have the mentality of, oh, it's overbought, it's oversold, it's overbought, I want to short it, based on what? The RSI, relative strength index, is a very common indicator that traders love to use to say, oh, when RSI is overbought, I want to go against it. This kind of system is not reliable. Why? Because when market is strong, it's extremely strong, it will go a lot further than you ever imagined. And that's exactly why majority of retail traders always lose money, because they are not actually understanding what is a pro trend. So let's say you say, oh, price is on a pro trend, I want to short it because I see a rejection here, maybe an engulfing candle here. Do you think it will work? Likely it won't. And that's exactly what I say. When price is on a pro trend, do not short it based on an aggressive entry model, because you are going to get killed 10 times, 20 times. Okay, go back to pound dollar, to our example here. Go back to our everything runs, but anyway, okay, so just remember what I say. When price is on a pro trend, that's the exact time where you have to apply a conservative entry model, which is you actually wait for market to shift before you start going against it. Why? Because again, market can often run a lot further than you ever imagined. The mentality of, it's overstretched, not valid. Overstretched, overbought, oversold is the one key thing to avoid in technical trading. Why? Because it's all based on your emotion. It's all based on your personal judgment. If I were to ask you, okay, if you want to go short against a pro trend, let's say price goes up, you say you want to go short here, what kind of information do you have? What makes you think the market is going to turn at that point? Just because of one candle? Not valid. Unless you say price is failing, which is what I say, assessing price behavior. Price is failing at the resistance multiple times and we have a shift in structure, then I'll say, okay, it's a good trade, it's a good setup, because you have a proper risk management measurement as well. You can say proper risk reward measurement. You can say, okay, because price is failing to break the high multiple times, we have clear signs of price exhaustion, we have a break of the support, break of the structure, you have a shift in structure, and you have a reasonable risk reward here, then I'll say good trade. Okay, but when price come back to here, when price is on a very clear market structure, a very clear downtrend with a very clear break of structure, use a limit order. Why want to waste your energy? So I hope all of you learned something new from this lesson here. Remember a few key things to learn here. First thing, candlestick pattern itself is unreliable. So let me just summarize it to all of you. So first thing, candlestick pattern by itself is unreliable. Second thing, one candle does not mean anything. Multiple candles does. Third thing, have a trading system that splits out an aggressive v conservative entry approach. So aggressive entry simply means you are just blindly going short against something, going long against something, or limit order can be categorized as an aggressive entry system as well, but the only reason why you want to use a limit order is because market structure is so clean that why do you want to waste your time to complicate your trading system. When the trend is established, there's a very high chance where it will just respect the prior BNR zone and continue pushing lower. When price is on a clear uptrend like this, very high chance it will respect the zone and just continue pushing higher. If you were to stare at this and wait for some sort of confirmation, most of the time you missed out the trade. And when you missed out the trade, there are plenty of consequences. You ruin your RR, you ruin your price position. The setup is just not so favorable anymore. Okay, conservative entry approach simply means you want to wait for certain things to appear and then you pull the trigger. That depends on your entire trading plan, your entire trading system. Okay, so I hope you all again learn something new here. Just remember, candlestick pattern is not a valid entry confirmation. Price behavior does. And then have a rigid system that tells you when should you aggressively short into something. Maybe because you see our price is on a pro trend and we are seeing a shift in structure, we are seeing price exhaustions, we are seeing the angle of the rejection is getting steep, and you are seeing that the speed of the rejection is very fast. Then from there you can make your conclusion. So price action trading, again, just here to tell all of you, price action trading, if you were to take it seriously, is a lot deeper than you ever imagined. But your task as a price action trader or pattern based trader is to make a lot of knowledge, compile them, and to fit into a simple trading system. That is our job as a trader. Having knowledge is one thing, but can you actually have a profitable system or not? Can you make complicated knowledge, squeeze them into one simple system? Okay, so that's it for the lesson. I hope all of you learned something new. If you like it, please don't forget to like, share, and subscribe. Bye bye.